I'm going to try to keep this at 10 minutes because I have 6 companies and it's going to be a bit crazy trying to get this done. Basically, I'm just going to deal with the gold market, but I'm going to deal with it at a very macro level. I'm not a gold bug, but I have come around to thinking that we may be at the start, I guess. I mean, you could argue that it started last June, but at the start of what I think is probably going to be a fairly extended rally. And by fairly extended, I mean 3 or 4 years. I have no idea what the top's going to be, and I don't really care, honestly. I don't like throwing around stupid numbers. I know if you were going to use traditional charting methods, you could easily throw some pretty dumb numbers around, you know, $4,000 or $5,000. I'm not even going to think about numbers like that. If it gets to 1,800, 2,000 over the next couple of years, and it's enough of an obvious uptrend to keep drawing money, and that's really all I care about. I'm not going to complain if it goes to 4,000 or 5,000, but I certainly don't want to see it spiking there. I'm looking for a fairly gradual decline, advance, 2 steps forward, 1 step back. You know, I'm not expecting to go to the moon straight up. I don't want it to. That's a bad thing. But I'm just going to walk you through why I think that's the case. To start off, you have to start off with this idea that really particularly over the past few years, some would argue the Fed's been this way from day one, but particularly over the last 2 years, 3 years, the Fed's really been, I would say, captured by the market. It's almost like Wall Street's holding them hostage, which I don't personally think is a good thing, but that's the world that we're in. Essentially, the Fed, to a much greater extent than I personally think they should be, is reacting to what's happening on Wall Street when it comes to monetary tightness or looseness. And if you look at those 2 charts there, the one on the left is basically a financial conditions index that Goldman Sachs puts together, and it's basically just how tight or how loose it is. The higher it is, the tighter the fiscal conditions are. The lower it is, the weaker they are. The one on the right is obviously S&P. The 2 arrows that I put in there, you can see 2 periods where it peaked in early 2016, late 2018. The financial condition tightening peaked, and in both cases, you can see how the market reacted, particularly in late 2018. The dive that we had at the end of 2018 was largely due to fiscal tightening. The market freaked out, the White House freaked out, the Fed freaked out. They turned tail, started growing their balance sheet again, started cutting rates again, loosening it again. We're at fairly loose conditions now, and I suspect they're probably going to get looser because the Fed's kind of trapped themselves now. And when I look at the market, I look at Wall Street, and to me it looks very overvalued, but in a sense it doesn't matter. It's all about liquidity, 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 period. As long as this deluge of money keeps flowing into the system, even things that should rationally make the market go lower may not have a big impact. I wouldn't be shocked. I think it would be ultimately a bad thing if the S&P ran up another 10 or 20%, but I also wouldn't be shocked if it happened. It would make no sense on fundamentals, but this market is not about fundamentals when you look at the Wall Street right now. This is all about liquidity, period. Here's a little more close-up look at it. This is a different liquidity measure than one of the other. I think this is actually also Goldman Sachs that puts this index together. And there's that against the S&P. Take a look at the last 3 or 4 months. You want correlation? There's your correlation right there. It's virtually 100% correlation between the global liquidity proxy and the S&P. Whatever. What do we care? How do we make money on this? Well, essentially, the federal government in the U.S. it's painted itself into a corner when it comes to fiscal monetary policy. The guys in Washington have been completely ridiculous about doing gigantic tax cuts, no spending cuts. There's very little prospect of fiscal deficits reducing anytime soon. The Fed, for reasons I personally don't understand, feels far more responsible for the stock market than it should. And the combination of those 2 things has got a situation, you're seeing it in the repo market in the last 3 or 4 months. It doesn't have to be in the repo market, that's just where this happened to rear its head, and I'll explain why in a second. But essentially what you've got is a treasury issuing treasuries. I mean, that's how they pay the bills. They sell those bonds in order to fund the federal government. Recently, especially, you're seeing a lot of those treasuries get bought back by the Fed as part of their repo market operations. And as gold bugs, and like I said, I'm not one, but as gold bugs have warned for decades, at some point you're going to see the U.S. government monetizing the debt. The transactions you're seeing flowing through the repo market right now, that is the US government monetizing the debt. That is what those transactions are. I don't know how long that's going to go, but that's the basic reason for my thesis that I think we're going to see a move higher in gold prices. And to show you how ridiculous the situation is, this is a very long chart that compares the unemployment rate in the US, essentially how good the economy is doing. The lower the unemployment rate is, the longer and stronger the expansion has been. It's plotted on this, that's in red. In blue is the US federal deficit as a percentage of GDP. Normally they would go together, which makes sense. If the economy's stronger, the unemployment rate's dropping, and in theory, the federal deficit should be dropping at the same time because their tax revenues are going up. They're being responsible, hardy-har. Basically classic Keynesian stuff. I shouldn't really say that word because Jay Taylor always tells me I'll be struck by lightning if I say Keynes, but I'm going to take my chances because I need it. Don't hurt me, Jay. So where that gets us is where I bring that around to the currency is in the long, there's things that affect obviously all currencies. It's not a static system. You've got all these currencies trading against each other. Short term, I would say the biggest impacts are real interest rates. Economies that have higher real interest rates tend to attract money flows. Ones that have higher relative growth rates tend to attract money flows and attract bond buying because they're safer. Longer term, it's basically the supply and demand for that currency, and the two things that tend to determine that is trade balances. Basically, if you're running a trade deficit, you have to create more money in order to pay for those extra goods that you're not generating enough exports to pay for. And current account, which is really just sort of a big agglomeration of everything the economy produces and everything it consumes. If you're running a current account surplus, you're consuming less than you produce. If you're running a deficit, you're consuming more than you produce. The US has been, as you can see from this chart going back about 20 years, chronic trade deficit got much, much worse through the aughts. And I don't think trade deficit's a bad thing. It's not, I mean, I know Trump goes crazy about it all the time, but really it just means that Americans found it made more sense and was a better deal for them to buy things offshore because they had a strong economy and a strong currency. It was relative value for them to buy things from offshore, and that's really what created the trade deficit. It's not an evil thing in and of itself. Most successful economies often have trade deficits for long periods. But when you get the two things together and you're looking at the current account deficit, again, big drop through the aughts, and a lot of that was because of the trade deficit. The current account deficit got smaller as we went through the financial crisis, and that was partially cut back on imports, but also money flowing into the US as a safe haven. And you saw that continue through the last, 2010 to 2014-ish, all the problems over in the Eurozone and stuff. You saw more money being pulled into the US. That helped our current account. It still didn't get positive, but it was less negative. It's fallen off again in the last couple of years. You've seen a little bit of a bounce in the last quarter or two. That's largely because of the trade dispute. US imports have fallen off because of the trade disputes with China, Europe, everywhere else. But still, because the US has chronically run these current account deficits for like 30 years now, it's gone from being a creditor nation to being a debtor nation, which means basically to cover these deficits, it's got to borrow overseas. Long-term chart of the dollar, again, if you look during the period through the aughts, through the 2002 to 2008, you see a big fall off in the dollar. That's largely because of the long-term effects of those big current account and trade deficits. They were basically printing money in order to consume more than they were producing. Came back up partially because the euro was getting killed because they had their own problems, and because the U.S. Federal Reserve did tighten a bit. U.S. had relatively high real interest rates, still sort of does. Was considered a bit of a safe haven. It started to fall off again. It lifted up again over the last year and a half, and it's starting to roll over now, and I think that rollover is going to continue. And basically, the situation they've got right now is the U.S. is running these bigger and bigger deficits. Normally, they don't have a lot of trouble selling bonds overseas, but historically, when the U.S. dollar goes up to a certain level, the foreign buyers tend to disappear in the treasury market. And I don't know why that is, but it's a well-known historical correlation. The dollar gets up to a certain point, the foreign buyers just kind of step back from the treasury market. So what's been happening, especially the last couple of years, because they keep running deficits, they keep printing these things, the guys that have been picking up the slack are the large banks in the U.S. that are called the primary dealers in the Treasury market. They make up the buy side of the Treasury market, and part of being a primary dealer is you agree to suck it up and just buy this stuff if nobody else does. That's part of your agreement as a primary dealer. So they did that, and if you look at the blue line in this chart going back for the last few years, you can see that the holdings of the major banks in blue of U.S. Treasuries just kind of kept growing and growing and growing because they were picking up the slack on these. And at the same time, well, it went up for a while, the cash balances of these guys started falling off about 2 years ago because they were loading up on Treasuries. Their cash balances were dropping. Under Basel II, which is an international banking agreement that was done after the financial crisis, largely as safety measures, one of the things that was set was minimum cash requirements for banks. They got back down to a level where they hit those levels in about Q3 2019. It should not be a surprise to you that when that happened, that's when the shit hit the fan in the repo market, because those guys could not inject cash into the repo market because they were right at their Basel II levels. They just couldn't do it. The Fed had to step in and inject cash into the repo market. And that's why when you look at the left side chart here, I'm going to run through this fast, I am running over, unfortunately. If you look at the left side chart here, that's the Fed balance sheet. You see how much it's lifted in the last 3 or 4 months. It's gone up about $400 billion. That is almost exclusively repo market operations, and what they're doing is going into the repo market, offering to buy bonds, largely treasuries. If you look at the chart on the right side, the red line is mortgage-backed security holdings. The blue line is treasury holdings of the U.S. Fed. They've basically been buying treasuries in the repo market in order to inject cash into it. That transaction, if you took a money and banking course, does two things. It expands the Fed's balance sheet, it expands the money supply. Here's the money shot. This is about a 15, 20-year chart. It shows two things. The red line is the growth, increase or decrease in the Fed's balance sheet. That giant spike you see after the financial crisis was, of course, them issuing money all over the place to try to keep everything from falling apart. There wasn't a lot of move down in the dollar. The blue line is the US dollar index, annual changes. There wasn't a lot of move down at that point because everybody was freaking out and going to the US as a safe haven. If you look at the right side of the chart, the last 2 years, you can see how the Fed balance sheet was decreasing, the red line, then it starts climbing again in the last 4 months. That's the repo market operations. You look at growth in the US dollar index. It was climbing, and it started falling off again about a year ago. The fall has steepened a little bit in the last month. That's because balance sheet growth equals money supply growth equals weaker US dollar long term. I think this is going to be a fairly long-term trend because I just simply do not know how the US Fed gets out of this. And it's not the Fed's mistake. It's not their problem. This is really being generated as much as anything by Washington. I mean, you go back and think about that deficit chart I showed you. If the US growth rate slows down at all, that's going to go through the roof. I mean, they'll be running 7, 8, 9% of GDP deficits. And there's nothing the Fed can do. There aren't enough buyers in the market. They have to go into the market themselves, soak up those treasuries, and in doing that, they're growing the money supply. That leads you to a longer-term, weaker dollar. And that's what I think, long-term gold chart, I think we're going to see that hold together because of that combination of transactions that I don't think the U.S. can get out of. I don't see any other way out for them. I think we're going to continue to see U.S. money supply growth. I think we're into another one of those long trends where you're going to see the dollar index fall off. The last time during the aughts when it did that, it went from about 110 to about 73, 74. It was a big drop. It was 30% over 5 or 6 years. I don't know if it's going to be that much. I could see it being 10 or 20%. The US dollar index is about 96 now. I could easily see it going to 80 or 75. If that's the case, you're looking at $1,800, $2,000 gold. Should be pretty much baked in the cake. And like I said, it won't be straight up. It's going to be back and forth, but I think we're going to have a pretty good gold market here for 2 or 3 or 4 years. And that's the reason why this room's going to get fuller. And I think we're going to see share prices of all these companies react accordingly. So I'm expecting us to have a pretty good time over the next little while. And I'm way over my time, so I'm done.